Welcome everyone to the November Fest community conversation. Great to have you here. We're really excited to have Sarah Edwards as our conversation starter and Fyodor as my co-host here. We've been using a Miro board to kind of track different things, and so I'm going to go over to that now. We have a little bit of a welcome and a check-in. We'll have a brief period of connecting in small groups. Then we'll move into the core of our time together, a collective inquiry with Sarah Edwards as our conversation starter. We'll break into small groups for about 20 minutes, come back to the full group for another 20, have a little bit of time for some updates and announcements at the end with Jen, and a quick sort of closing and checkout. One of the core purposes in these calls that we've now got a slightly different format for than what we were doing for the last couple of years with Fest is to give people more of an opportunity to build relationships, to meet new people, to connect more deeply with people that you already know, as a core offering that Fest is making to the field, in addition to framing a collective inquiry that can inform all of our work as people that care about financing systemic transformation. So we're shifting from an approach that was more centered on a presentation and sometimes what felt even like a pitch coming from our main speakers on these calls, and instead having them give us more of a provocation for dialogue that, and set the context for a conversation we all care about. Are we ready for small group connecting conversations? So this is just before we dive into the material, just to land with your groups, get a little bit of a sense of who one another is, and then you'll be back in these same groups after we hear from Sarah to reflect on what you heard from her and a question that we'll pose at that time.
Well, welcome everybody. Welcome. So if something stood out for you, some kind of surprising thing or some kind of pattern you noticed in your introductions, just share one or two sentences and we'll hear from three people and move on. Okay?
I'll do one.
Yep.
In our breakout room, I think everybody's feeling a bit heavy at the moment. There's a lot going on. There's a lot of negativity, but we also, I like to think we finished our breakout room with also trying to remember what things to be grateful for. And that is that there is some hope, there is some brightness, and there's connectivity and family and festive times that we're all looking forward to. So it's like, yeah, it's COP 30, like, right? 30 years they've been having a crack at it. They've still not got there. But 2 million hectares of protected rainforest this morning that's been returned to indigenous communities. So there is stuff that's happening. There is hope. That's why we're together.
Beautiful. Thank you, Pete. Let's take two more. Anybody else wants to share?
Madeline had an interesting thing that she put in the chat about a new UK government initiative on social investing. So
let's take one more.
I can jump in. I came late to my group, but there was an interesting, just highlighting something I think we've all experienced, which is the huge gap between the big money and the little money, what needs to happen on the ground, and what, where the big money is moving to the $100 million, billion transactions, but how do we actually anchor stuff, and what's the missing middle? And I think that's a kind of a consistent recurring gap that we see in a lot of places.
Wonderful. With that, I'm handing it to Ben.
Yeah, well, and that segues into what we're going to be talking about today on this call. And just want to review again a little bit about, why Fest and what is this process that we're in today. Fest exists to accelerate the development of this field of financing systemic transformation that includes people working at many, many different levels and contexts, both placing money, receiving money, trying to orchestrate and theorize about how we can work in a more systemic way. And the sense is that the field itself is underdeveloped. It's new. We're still very much learning how to do this. And so sharing our experiences and being in collective inquiry is really crucial. And it's something that this initiative was formed 2.5 years ago now, I think, almost 3, to play a key role in support of many other groups that are also, have been Fest members, or whose the people involved in those groups have been active in Fest to support and develop this field, with the idea that this, investing in a systemic way is essential to systemic transformation. And as I mentioned before, the collective inquiry process that we're using for these calls now is a bit of a shift from what we've been doing previously, where it was more of a presentation followed by a Q&A. It's going to center around a particular question that Fyodor and Sarah and I have been working together to craft in a couple of meetings prior to this. So Sarah is our conversation starter, and she'll be providing a kind of a story about the context she's working in to set the context for that question to be discussed in breakouts and then back in the full group. And we'll hear a little bit of final reflections from Sarah on that as well. So with that, I think I just want to introduce Sarah, and I think Fyodor will have a little bit to say about how we got to this point and how this bridges in with the previous conversation as well. So we're really delighted to have Sarah Edwards as our conversation starter today. She's the Senior Investment Director for Sustainable and Impact Investing at Cambridge Associates. She spent years involved in ocean climate change science and working at the global policy level, did graduate study on the link between the private sector and environmental responsibility, worked on corporate responsibility strategy in the mining and oil and gas sectors, had a management consulting career after graduate school, and currently she's at Cambridge Associates, where she blends her perspective in operations management with her experience in environmental and social stewardship to amplify impact through an investing lens. And I think that's enough. She will probably tell you more, not about the context that's most relevant to what we're here to talk about. But I think, Fyodor, you wanted to say a bit too about how we got to this, what the flow is from the conversation that we had back in September with the first of these community inquiry focus calls and this one. And it actually speaks to the comment we heard from Karen just a couple of minutes ago as well.
Yeah, no, thank you. Thank you, Ben. Yeah, so I was a conversation starter in September, and I talked about this thing that we discussed in the systemic transformation field for many years. That's the gap between how things are done with large amounts of capital, which is very low context, and you need high levels of abstraction to operate that. And institutions are designed to move money in that way, and then how systemic transformation works on the ground, which is high context, it uses emergent strategy, so it cannot commit to results. The capital allocation should really be not controlled by somebody who doesn't understand the context. And so I was asking how we were dancing with these polarities, and Sarah was writing in the chat like, well, at Cambridge Associates, we don't dance with that at all, or something like that, right? And it's like, that was the starting point of the conversation, and then we were in the same breakout room. And, we're trying to, I brought up a metaphor of building a tunnel from two different sides throughout the mountain, right? And we need to meet. Yes, even if we don't see each other or don't dance just yet, for systemic transformation, we really need to build those connections. And then Karen, who was also in our breakout room, said, don't build tunnels, build bridges so we can see each other as we build. And that was really when the idea came about to invite Sarah as conversation starter. In our second conversation, it's like, yeah, okay, so we heard about it from the grassroots and community-based perspective. So let's just go as far as possible with Cambridge having, Sarah, please correct me if I'm wrong, about like $600 billion under advisory, $260 billion under management. And here is what we're going to do today.
Thanks, Fyodor, and thank you, Ben. Look, I'm so pleased to see so many familiar faces. Our goal with this conversation is to bring the perspective of the institutional investor. And as Fyodor mentioned, Cambridge Associates is a big fish. We work with about 1,000 clients across pension funds, families, endowments, and foundations around the world that represent collectively just over 600 billion in assets. So when we talk about where the big money is going, like I know where the big money is going, I can tell you where the big money is going, and the small money is still very, very small. And maybe that's right, or maybe not, or what are the questions we should be asking? Well, we'll get to that. But I thought that sharing some of the perspective of Cambridge Associates might set some helpful grounding to hear from all of you. And in the introductory breakouts that we just had, I was with Graham and a newcomer, Kira Burrell. The three of us were chatting about how this group of people is a really beautiful convening that I don't normally get access to. I wouldn't otherwise have these sorts of conversations. So it's very important to me, and I was honored to be asked to present, because what I think would be helpful for everybody, and would certainly be helpful for me, is to generate some thoughtful questioning and critical thinking that we can translate to the institutional thinkers the big money. What are the questions we should be asking in our daily lives, but also if we are interested or we have asset owners and institutions that want to think more systemically, what are some of the questions we need to be asking? So I will spend just a few minutes level setting how we operate, how we think about portfolio management. So some of this stuff is boring. We included more slides than I'm actually going to talk about, but this is important. It may be boring, but it's important. So how do we at Cambridge Associates work? I mentioned we have about 1,000 clients, right? We're set up in different practice areas. One of our practice areas is working with families, private clients. We find that families are more flexible, can move faster, are more interested in pushing the envelope on systemic investing and deeper impact. That's not to say foundations aren't there too. They definitely are, and we work with some of those foundations. But for just ease of presentation, I wanted to share Cambridge Associates is part of a lot of other things that go on in a family. They have their own tax advisors, their own legal professionals, their own custodians, their own trustees. The structure can be set up in such a way that sometimes families, the families themselves don't even have any control over the portfolio, and it's all about the trustee relationship. And so Cambridge Associates, as the investment advisor, sometimes the outsourced chief investment officer, we need to be aware of all these other dynamics. And sometimes we have a lot less discretion and a lot less control than we might want when it comes to impact. So this is an important piece. I also recognize for many of you here, this is total 101 stuff that you already know, but in the spirit of level setting, I think it is a very important. So there are a lot of other actors here. I would say the trustee role is something of a conundrum and has been for decades, a conversation about what is a trust, what is a fiduciary duty, and how do you bake impact and systemic impact into that. That's another conversation, but is one that's, always a strong undercurrent of the work that we do when it comes to impact and systemic investing. So when we talk to families, they not only have other actors that are involved, but they also have their own spending needs, their own philanthropy, their own risk tolerance, what keeps them up at night. So at Cambridge, we're, in the beginning of a relationship, always asking about that. And that informs how we build a portfolio. That all of this stuff becomes really important. And it informs the structure too, meaning how far can you stretch down that tunnel into the high context stuff really matters. It starts from this higher level, introductory table setting kind of conversation. But once we get through all of that with a new family or new client, we will have this conversation about their risk, their interest in returns. And this is a helpful schematic. We are always trying to go for the highest returning assets, right? Typically at Cambridge, but how do you do that while managing your risk? If a family or a client has very high spend, that can mean a lot of different things for different organizations, but typically 5% or more tends to be a threshold where you have to start talking about what actual investments can you make. So if you want, we think about this balance all the time. If you are very conservative and risk averse, then we might construct a portfolio that is more in public markets, or that's the bigger money, let's say. If you are really a long-term investor, like multi-generational investor, you don't need to use the capital, you don't spend it very much at all, and you want very high returns, we might do more in private investments, but you don't have access to that money as quickly. So the portfolio construction and asset allocation conversation changes. So there's always this mix and match. And at Cambridge, we don't have a model portfolio. We don't have funds. No one portfolio looks alike. So I mentioned we work with about 1,000 different clients, and we have just as many portfolios. They all look different. And it starts from one of these places where we understand the spend. So one of the questions that Ben and Fyodor and I discussed when we were prepping for this call is, well, where should we be if we want to invest in systems transformation? Where on this graph should we be? And can we start talking in this kind of language with institutional investors to help them understand, is there another dimension of systemic investing in here that's worth layering on so that we can have a discussion, a real discussion about what is the purpose of this capital? What is the real time horizon? And it's all still at the very high level. We're not even talking yet about what actually are the businesses that are underlying in those investments, which is again part of the high context, low context tension in this space to me is that we are constantly talking about this asset allocation. Here's what equities are supposed to do. Here's what fixed income is supposed to do. And so this is where, having minds like yours, Graham, on understanding like what's supposed to happen, what are our prior assumptions we're making about the future becomes really important. So we can sit on this, or you can sit on this in your breakout groups if you'd like to kind of come up with some different structures. But just to make sure that I accurately convey like where we're coming from at the top of the capital stack, right? Is diversification is often referred to as the last free lunch. So we're constantly trying to make sure that our portfolios for our clients are diversified across asset classes. So where we want high growth in the blue, we will balance that between public companies and, well, public managers that invest in public companies and managers that invest in private companies. Again, with where we're coming from in institutional asset management is we don't invest directly in companies, we invest in funds. Again, that's another avenue of limitations to reaching down this tunnel of high context investing and systemic investing, is we are still intermediaries and still several layers away from the underlying investments, to say nothing of the actual stakeholders themselves. Pete, you and I have had conversations about this before. So we come from such a high level that getting all the way down to that high context can be a real challenge. You can look at this if you want to later, but like, welcome to the world of institutional investing if you're not involved here. But this is a very typical way of how we would think about what a portfolio will look like at the end of the day. So let's talk about if someone says, oh, I'm interested in systems transformation for climate investing in emerging markets. Well, within a Cambridge Associates or institutional investment context, where does that fit in a portfolio? There's maybe in this emerging markets bucket right here on the left, the 5%, that's probably public equities, probably not private investments. So when we think of when people think about like, oh, it's just $5 million, or it's just, it's going to be this little thing, like, why doesn't that fit? There's this whole structure that happens from the top that constrains the ability to get to that high context, flexible orientation. So the mandate really matters in terms of where capital can go. I will skip down to what ends up turning into the portfolio. And just to add this gray bar, we talked a little bit about asset allocation. This gray bar here in manager selection is the other element, the value add, right? So Cambridge Associates always talks about, our edge is in manager selection, which it is, it really matters who you partner with from a financial return standpoint. It also matters from an impact standpoint. But as we think about how we deploy capital, it always goes through managers. We don't have the capabilities to do direct investments for a lot of reasons. We kind of do on the margin, but it's not yet at the element of even traditional impact, much less systemic impact stuff. If you have a smallish foundation, it's harder to do private investments, but they still want to be systemic. What are the questions we should be asking? What are the ways that we should be helping them be more systemic? And then finally, just in the interest of time, for greater context, Cambridge Associates historically has said whenever a client will come to us, be it a foundation or a family, they will sometimes ask us, can you help us with some place-based investments we want to do? Or we would really like to do more in impact. We want to be impact first. We want to be catalytic. We want to anchor funds, first-time funds. Cambridge has said, no, we just do market rate returns. So in this spectrum of capital, which I imagine you're all familiar with, but Bridges Fund Management really started this a long time ago, maybe 10 or so years ago. Cambridge Associates has traditionally been in that traditional, responsible, sustainable space, and then a little bit into the impact investing, right? All the way, maybe halfway through to the market rate return area of impact investments. And we haven't been willing to accept either below market rate returns or higher risk investing for impact until a couple of years ago, which I've said to many of you, and part of what I was lamenting about to Fyodor the last time we chatted was we have now some capital that is telling Cambridge, that sees some potential in Cambridge to test new things and sees the seeds of their investments that could make their way into other pools of capital within other clients that are kind of in our Cambridge family. So that's very exciting. So now Cambridge Associates is like, oh, wait, maybe there is a role for capital to play further down the spectrum. And how can we now is our opportunity to seize that moment and to infuse more questions of systems transformation. There is a moment I can feel very palpably within the firm that we want to do this right. There are lots of questions we're asking about, not necessarily using the term ergodic, Graham, but we are asking, like, what are the risks we're not seeing? How do we better bolster portfolios to handle systemic disruptions in the future? And how can we more proactively put capital to work that works to build that, tunnel through the mountain? I believe we have one question to ask everybody, and I'll just leave it to Ben and Fyodor if you wanted to add to any context to this discussion before we share the question.
I think we're just going to pose the question and go straight into the breakouts to maximize the time we have for some dialogue. You've all heard, I think, something that sets the context for you to think about this. And so what we want you to talk about is this question, what are the questions advisors need to ask themselves and their managers to open up the possibility of financing ecosystems for systemic transformation? I think what we've heard from Sarah is the conversation right now is a long way away from that. Just getting into traditional, impact investing is a stretch. But let's go into the breakouts now, and we'll see you back here in 17 minutes.
Welcome, everybody. Okay, so how did it go? Who wants to go first? What's that one thing that stood out for you?
I'll say something. I was looking through the list of everybody here, and if I'm determining whether I'm the only person who's in the category of the question of being a manager that is asked the question of how do you do systemic transformation. I don't believe anyone here, and it doesn't make me special. It just makes me have some lived experience in this challenge. When it comes to getting a manager or someone who is, like, if you're a community foundation, board member, or you're a pension trustee, or you're an asset manager for a client, in all those cases, you're someone who's making decisions for a pool of assets, right? So then the question is, for someone who's making decisions for a pool of assets and allocating within that pool, how do we get the decision makers for allocation to make systemic transformation investments? And the challenge initially is to define what investments of the marketplace of investments that are available are actually representative of systems change that could be made by an investment manager, so that decision-making process could evaluate the options available. So first, it means defining the options available to the manager, and then ensuring that the manager can actually functionally, operationally allocate to such an investment. So, for example, if there's a loan that is needed to a particular type of institution to make a change in the way that they operate, that would be a systemic investment. But if the manager is not able to make discrete loans that are outside of a security, then to enable managers to make loans is an example of that second challenge. So these are very basic, fundamental rails or operational constraints that have to be considered in order for those managers who are constrained in the system of financial management to actually participate in the conversation. And then there's a larger question that we also address in our group to actually, in the marketplace of people and groups receiving capital, define investable opportunities as well.
We're going to start a fest hedge fund.
Yes.
That is it? All right. Who wants to share another observation from the conversations?
I think one of the questions that was raised, apart from realizing that we should start a hedge fund to fill a gap in allocators that are doing the systemic thinking, when the question was raised was like, Sarah, how can we help you? Like, what would be helpful from this network when you think about leverage points in your ecosystem? Is it trying to stimulate wealth holders to ask the right questions? Is it something else?
Okay, and we will hear from Sarah as she shares final reflections from the conversation starter at the end. So Sarah, please take note of these, and maybe you want to respond to that later. And with that, Steve, go ahead.
I just feel incredulous that after the scale of polycrisis that is so evident, that there is not some cracking in the traditional backward dependent, historic dependent projections of what the future is going to return. And whether there aren't some cracks that are developing, thinking of all the work. I mean, 10 years ago, I could understand people were, the situation was very different and people could be saying, oh, it's not going to be that bad. But seeing, for instance, the insurance losses, just as one great example, are there cracks that are emerging to be able to start widening in that historic-based scenario?
Can I talk to that a bit? Which is that I'd say in a hopeful way, I think the cracks are showing. I think that we're looking at them. Like Sarah just gave us a presentation where she was talking about the fact that the whole of Cambridge's business is being pushed by the intent of investors to have more impact. And I think that, we are having this conversation is part of that opening of a fissure, right? Like there is huge intent, positive intent in capital right now, and there's huge frustration that stuff isn't changing. So it's this, yeah, exactly. Here is the crack. The problem is the pipe work. It's not the intent at either end. The reason we're trying to build a bridge from each side is because that's the crack, right? Like humanity knows that this is an issue. There is no ROI on a dead planet, right? Like if you're making a multi-generational investment, you have to have a planet for that generation to be on. And I'm finding this all the time is that the layering between, like when you have somebody who's been super successful as an entrepreneur and made themselves, hundreds of millions, and they're trying to deploy that ethically. Part of the problem is the number of layers between them and the actual deployment. And there's also the challenge is that, and this is something Sarah and I have talked about, is how do you scale something from a micro to a macro to enable large scale deployment when you have all of these layers, and the layers are made up of people who are then risk averse at every level more because it's not their capital, but it's their job. So it's their livelihood on the line, right? If they deploy 10 million out of a 100 million portfolio and it goes to zero because they didn't make the right choice, if the guy who had the 100 million had made that decision, well, that was his decision. He put the money on black, right? But if it's a bloke whose job that depends on paying his mortgage and putting his kids through school is making that decision, that layer creates risk aversion every single step down. So you have these kind of layering. But we're desperately trying. I spoke to a family office recently and they're like, I've just taken all my money out of this fund because I decided that they couldn't deploy it. Risky enough for me, right? So this is the crack. We are the crack. What we've got to do is start pushing it. And this is what we're doing. So let's be hopeful on the fact that, there are solutions.
That's awesome. Thank you so much, Pete. Corey, go ahead.
Yeah, thank you. It struck me that the slides and the accompanying presentation, really outlined a very coherent way of thinking about asset management, about investing for clients. It's very client-centric, it's very reasonable, it's very risk-averse, or rather dialing in risk tolerance for the client in terms of, I think it was that third slide of green, blue, and yellow, different types of far future, intergenerational, and then current beneficiaries. And that seems like a way in which clients would want to have that conversation, and I'm sure it's connected to Cambridge's success. And I wonder could that just be perhaps door A, where it's determined by whoever's doing the initial intake, the client manager, that this is the conversation that we're going to have that's been working well. But is there also a door B where earlier on in some phase of the intake, an attempt is made to understand a little bit more about how the client sees more existential risks, how the client looks at impact, what is their more systemic outlook, and don't just launch first into, although Cambridge is an investment advisor, it makes sense to jump into thinking about return immediately. Just kind of phrasing, I wonder, Sarah, has it been broached, the possibility of looking at different strategies for conversations instead of running people through the playbook that has worked well?
Thank you, Corey. Isaac?
Yeah, well, we had a great conversation in our group and lots of things pinging for me. One of the things that we were thinking about is a lot of these asset managers and advisors need to do continuing education and get credits for sort of like staying up to date. And so I'm curious, basically, upstream of them, where are they getting information about what is possible? So back to like defining the investment opportunity or defining the vehicles. I don't know if this is the question they ask or someone else asked, but basically if there was a way to shift the information they're getting about what this thing is, then they wouldn't have this experience of hearing a request, which is I want my money to be more impactful, and then saying like, well, I don't even have like, you should go create a DAF, or like pushing them, like channeling them away from where you could create a crack in the system. And we also just talked about generational change and maybe using that as a forcing function for these advisors, saying there's this change coming, this is what your clients are going to want. And so that could be the kind of impetus to relay new piping, to use that metaphor, rather than just sort of a polycrisis frame, which maybe locks them up, kind of more of like your clients want this thing, so you should learn how to develop it.
Thank you. Let's take the last one from Braden.
I don't really know how valuable this might be in, you said questions to ask or provocations to ask just to managers in those positions. I guess I wanted to share sort of like the thing that opened my eyes to the possibilities, and it did specifically involve finance. And it was in a cartoon. I don't know if you guys have ever seen Rick and Morty, but there's this one episode where in order to collapse the galactic government, they changed the value of the currency from 1 to 0, and everything just stops, like everything just like collapses, and there's chaos that ensues. But the thing that like really struck me was nothing actually changed. And sort of like the way that our actions were sort of perceived to be linked to numbers on a screen or numbers on a page, when physical reality remained the same and could have easily been averted. And I guess it's sort of like having those aha moments, like when you realize that the foundation of the economy isn't actually real, or like when money isn't directly tied to value, or the way that our economics is structured is structured by us, and it's not something that's like a god that you have to bow down to. Maybe those types of provocations, they're a bit more intuitive. They're not quite as, logic driven, but those are the things that I think tend to like get in people's heads more. And maybe that could be worthwhile.
Wonderful. Thank you so much.
We're passing it to Sarah.
Okay, well, I think my first reflection and feeling is just a great deep gratitude, because you all have just spent the last hour plus grappling with this with me. And candidly, I don't have a lot of people to grapple with these things with. So I'm very grateful to all of you for taking the time. I wrote down a lot of notes, and I'm thinking about things like process a lot lately. Frameworks are important. And so these two things have to happen in conjunction. I am always looking for ways, like this group is very thoughtful. You guys are at like 401 level here with systems transformation. So I'm constantly trying to translate. And somebody wrote on the Miro board about advisors for the advisors. And I don't think that's wrong. I mean, we need to educate ourselves. What is the right way to do that? What are the right conversations that I should be bringing into a wider audience within Cambridge to start to bridge that? And then Madeline, you asked about what can you do to help us? I mean, it is very catalytic for us to have the mandate. When a client says, yeah, returns are important, but what really matters is impact, that is transformational to Cambridge. And that's what we need. Like I'm telling you, we have so many really cool impact forward ideas that we can't execute on because we don't have the mandates. And we are still trying to build the categorization. This also came up in a couple of people's remarks that what is that carve out? Is it a carve out? Is it a mandate? Is it a niche that's like, what is that structure? When we have the mandate, we can start to create that, but then it starts this whole other layer, speaking of like pushing that crack wider open, like, okay, now we have catalytic systemic. That's going to be different from an emerging manager portfolio. That's different from a place-based high context where we are working more closely with a philanthropic part of an institution, which we're starting to do too, by the way. So there's so many more ways we can stretch and push that crack open further. And the mandate is the thing that's going to really help. And other things will follow, and deeper partnership with all of you will also be great going forward. So thank you.
Thank you so much, Sarah, and everyone for these reflections. And I have this vision that these calls just start a conversation that ripples out and continues in ways that we can still have visibility on. So of course we have the Miro board, but maybe there are people that want to keep talking about it with Sarah, with others that you were in breakouts with, or other people that were here, or people that weren't here that have something to say. And we may not be quite ready for that in terms of creating the container for it yet, but it's something I would love to see. And if people are interested in that, do let us know. Our next call will not be next month. We're going to do it in January. So we're also still thinking about who the conversation starters are, but we do see this as kind of a flow. So we started with Fyodor sort of at the high context level. We've had Sarah from the low context level, and we're looking for someone that's playing in the middle, perhaps as that bridge. And we have some ideas for people doing that work and thinking about that work that we might bring in. And with that, I think I want to turn it over to Jen to talk a little bit about what's going on in FEST more broadly, just give us a little bit of an update on that. And then we'll do a quick closing checkout in the chat with one thing that's on your mind as you leave this call. So Jen?
All right, I'll be quick. So there's a whole bunch of slides in the Miro. I will not bring up on the screen right now, just describing all of the activity going on. Up to date, this has been voluntary, some capital provided by our early founder, Steve, to get some of these prototypes research going, but we've done learning and action research with 3 extraordinary prototypes. One of them is here represented, Quaxala and Pete. Some incredible research groups that have spun out of FEST, building a paper like how to build the field of systemic investing. We have a finance group that's actively meeting every 2 weeks and has some very innovative ideas we'll be presenting in, I think maybe we present at the next January meeting about how to pool capital, to use convenings to connect, system stewards and ecosystem builders and folks on the ground with capital holders, institutional wealth holders, to understand how we start to shift this. So do this as like a learning action inquiry about capital readiness on both ends, not just how to get projects ready to be recipients of capital or how to deploy capital, but as Pete pointed out, how do we actually transform capital? We have a mapping group that has not met. That's part of the update as well. And the convening group, which is, thank you, Ben, also Magdalena, who's not represented today, who will be organizing, I think with Fyodor, our next meeting. And if folks are more curious about that, reach out to me, reach out to some of the folks on this call, especially if you're deploying capital or I used deploy, transforming capital, or, ecosystem steward type human trying to get systemic shifts in the work that you're doing. We're really eager to hear from you. We're eager to have you be a conversation starter, or even join our finance group to see how we can start to move things around.
Great. Thank you, Jen. That was perfect. So we got just a couple minutes for people to talk about one thing that's on your mind as you leave this call. Drop it in the chat. But if you have just a few words you want to say, and we'll see how many voices we can hear in the next minute and a half and still end on time. What's one thing that's on your mind as you're leaving this call?
We are the crack,
Crack widening.
I think we have to come up with a better terminology, but the analogy is good.
Agreed.
Transform, not deploy, we have from Sarah.
Bring the mandate.
Start the hedge
Gregor
fund.
is excited about hedge fund.
Yeah.
A lot of questions about that.
That might be our February conversation.
Yeah.
Biggest problem isn't intent, it's infrastructure and piping. And Corey says, I appreciate the genuine inquiry into systemic transformation within a very large, successful, well established in its ways system.
Yeah, and to build on that, I personally am living with the deep gratitude to everybody on this call, holding this intention so many different ways in different parts, and especially grateful to Sarah, because it is such a treasure to have somebody from that scale and that part of the system to be in genuine inquiry with people from different parts of the system sitting here and figuring out we're in this together. How do we go from there? Thank you so much, Sarah.
Yep. Thank you, everybody. And thank you, Steve, for getting this whole thing started almost 3 years ago now. I can't believe it's been that long.